Hey everybody, I'm Chris Parinello, the Director of Investor Relations for Viking Capital. We'll walk you through our latest investment opportunity as well as provide updates for our 25th acquisition, Stewart's Mill. We are so excited to dive into this asset and its key fundamentals that highlight what an incredible opportunity it truly is. I will be joined by our VP of Acquisitions, Judah Fold, and our CEO, Vikram Raya. Without further ado, I'd like to introduce you to a renowned cardiologist, international speaker, founder of Limitless MD, and our very own co-founder and CEO, Vikram Raya.
Hello everyone, greetings. I'm so excited to see all of you guys here on the webinar. So I'm really excited. And guys, this is gonna be a fun day today. We're gonna get into why this latest acquisition for Viking Capital really makes a lot of sense. Viking Capital was really an idea started by myself and my co-founder, Ravi Gupta. We were both successful professionals. I was a cardiologist, he was an internal medicine physician, and we really wanted to figure out how to earn money, protect against taxes, and really grow our wealth in a smart and intelligent way. We tried stocks, we tried options, we got bonds, we did different things. And then we finally stuck on real estate. And then we tried doing single family homes and things. And we had success there. But the beautiful thing about multifamily or commercial real estate was the ability to scale. All the real estate asset classes out there, I'm a cardiologist. I like to stress test things. And of all the asset classes, when I stress tested multifamily real estate, it stood the test of time. I have an entrepreneurial background now. I've started multiple companies. I've taken them all to 7 and 8 figures. But the beautiful thing about Viking Capital, it's built on team. It's built on principles. So let me tell you the principles first. We believe in creating equity for our investors. We believe in protecting against taxes. We believe in diversifying across the country in multiple different assets. We believe in creating appreciation, forced appreciation by infusing capital into deals, improving and value adding. And the other way to do it is finding markets that are about to emerge or explode and really investing in those early. And then finally, cash flow, right? We believe in something called mailbox money. We would love to have monthly cash flow to our investors consistently. That is our investment thesis. Parts of the country that we like to invest in, we like to invest in the Sun Belt, we invest in Texas, we invest in places like North Carolina, Florida, DC, Indiana. These are places that are really growing and there's overall landlord-friendly states. And these are places that we're able to find those value-add projects. A little bit about our track record. We've been around. This is not our first rodeo. Our company has been around since 2015 and I've been doing real estate since the mid 2000s. And we've acquired 24 properties. Stewart Mills will be our 25th property. We're on track, most likely to hit $1 billion of assets next year. We have about 5,000 units under management. We are averaging about a 24% return, average annual return to our limited partners, or also our known as our investors. Where our assets, here are some of the states where our assets are represented. We're in probably 8 MSAs or cities. And here's where our Viking investors are located. All the investors are all the ones in the orange. 94% of the country, 47 out of the 50 states our investors are from. The thing we pride ourselves in, not just in the new investors that come in, we're very thankful for all our investors, but I think a test of a company is if people reinvest, and we have almost a 67% reinvestment rate. So we're really proud of that. Stewart's Mill is located in Atlanta, Georgia, one of the strongest MSAs. We have a large presence there. We've done, I think, 12 deals there. Middle of the fairway deal. It's 188 units. It's a B-class deal, 1988 built, well taken care of, owned by institutional owner. They've done a lot of the exteriors and they've left a lot of the quote unquote meat on the bone, the interiors for us to sort of take over. Statistics on the deal, 19 acres, so it's diverse, it's pretty spread out. There's 12 buildings, parking on site with 12 detached garages. So this shows you the clientele is a little bit higher, that the fact that they have private garages. Square footage is reasonable, close to 900 square feet, very attractive in the Atlanta submarket. The vintage, though it's 1988, I think almost $3.4 million has been recently infused by the previous ownerships. It definitely looks a lot newer. Why we love the deal. Number one, basic formulas of success in multifamily is value add. Buying an existing cash flowing, well-functioning property in a good area of the country, improving or upgrading some aspect of it, whether it's operations, interior, exteriors, or just increasing operations in such a way that it drives rental income up, it drives NOI up. And this is what we're doing. 73% of the interiors are primed and ready for renovation, and that's our business plan. Already well occupied, 95%. There's cash flow from day one. Since we own so many assets in the Atlanta submarket, we're gonna have a lot of synergies with property management, with asset management, with supplies, team members being moved around. We know what to expect in terms of how these properties operate, and we can operate them very efficiently. We got this deal for a $4 million discount. This was listed as a $32 million deal. We had that best track record. We had the most experience. We had the lowest price, and they ended up going with us because they wanted a surety of close. You can see here, very well-maintained property, beautiful pool, beautiful clubhouse. I like when it's more family-friendly apartments, and what that means is usually more 2s and 3s. And the fact that almost 70% of the properties in 2s and 3s, but there's still 1 bedrooms, which is good for like the working professional. 73% of the units ready for upgrades. This is a breakdown of exactly how we're planning to go about that, and we're going to renovate all of it.
You can see here from the pictures, the units are classic. The bottom left, for example, is actually what they consider a partially upgraded unit. So, there is plenty of room for us to bring this up to modern day tastes, and the renters in the market and comps nearby have already shown the appetite for a more updated product, and they're willing to pay more to rent those units.
And when we do upgrade it, the Viking level upgrade is pretty high quality. Sometimes we do, depending on if we're doing an A-class property, we can put in like granite quartz. In properties like this, we don't want to necessarily over renovate. And so we're putting in marble countertops, cabinets, stainless steel appliances, flooring, upgraded lighting. The end product is very attractive, and the tenants are willing to pay for that. Why we love Atlanta. 3rd most Fortune 500 companies in the country, $429 billion of revenue. Here's some of the big ones: Home Depot, UPS, Delta, Coca-Cola, some of the big medical care facilities. We look for cities that have positive growth. People are moving in. Every year, almost 50,000 people are moving into Atlanta. Actual population of Atlanta, 6 million people. And the unemployment still remains low, 4.3%. Catalyst for Atlanta's growth, busiest airport in the world, Atlanta, Hartsfield. What we call smart warehouses. These are logistic industrial warehouses, higher income jobs than the traditional warehouses. As we talked about, all the leading job providers, the healthcare is another big one. Rivian, a big electrical vehicle car manufacturer, is based out of Atlanta now. They're creating jobs. There's a $5 million plan, $71 billion impact per year of the airport. The Porsche North American headquarters relocated here. The tourism industry is very strong. Atlanta just got awarded the FIFA World Cup. We mentioned the studios filmed here. In terms of education, about 300,000 students. The medical industry, healthcare, 10.7% of all employment, which is a very stable employer. The demographics are shifting to where these millennials now, they're not ready to buy a home yet. By the time they buy their first home, typically it's between the 36 to 42 range. Most millennials right now are in the 28 to 34 range, the prime rentership time for them. So 63% of these people from 20 to 34 are renting. Since 2004, there's been about 3 years where there's negative rent growth. In general, rent growth follows the inflationary curve. Inflation actually helps real estate. Every 6 months to a year, those reassessments get factored in. This is why people love multifamily, because it's an all-weather vehicle.
So cap rates are a measure of risk and often the key tool in valuing real estate, right? You take the NOI, divide it by that cap rate, and then you get to value the property. As cap rates go up, well, values can go down. So where are we going to go from here? These are the long-term averages. Unsurprisingly, as interest rates have gone down, cap rates have come down also, given the cost of capital. But as you can see now, they've already started to kind of trend in a good direction. Most importantly, this is the impact it has on transactions. When things move so quickly, I look at the rise from 2020 up to 2022, then factor in the way interest rates then shot up. No one could underwrite deals. Things are moving too quickly. Buyers and sellers, they couldn't come to a meeting of the minds on a price on a property, and transaction volume shot down. Now, as I mentioned in the last slide, as those increases in rates really slow down and we're going to plateau on rates, now buyers can underwrite the same way sellers can underwrite. Debt isn't going to change dramatically in the 60 days you're under contract, and deals are starting to happen again. Prices have changed, prices have come down, which really presents a tremendous buying opportunity for the deals that work for groups like us. You might have heard us talk about value add and the 73%. Let me just kind of speak briefly to what we're talking about here. This property was built in 1988, and for 73% of the units, it looks like it was built in 1988. That's not a bad thing. These sellers are taking great care of the property. In fact, it's a great thing for us as the new owner. If you look at nearby properties, other properties have shown a demand, newer product, newer kitchens, nicer countertops, better lighting fixtures, and when that happens, those properties command $200 and change or more even, and rents higher than rents on site here. We have the opportunity to add value, which means increase the rents, increase the revenue and the net operating income at the property, which drives a much higher value and a higher sale price. With 73% of the units in need of renovation, that's a lot of units where we're going to be able to add that value. As an example, there's $50 of organic upside. Here's how we can actually force appreciation, right? We're not betting on the market to increase rents. We know that if we keep the market as is and renovate these units, here's what we can do. We can take 1224 rents up to 1370 in the 1-1s, and on the far opposite end, on the 1832s, we take 1568 rents and they'll be at 1848, 1850 after we do our renovation. Look on the left, that's a classic unit. If it doesn't transport you back to 1988, I'm not sure what will. Those are fun times. I'd rather have a new kitchen though. Look on the right, that's what's already on site. These are the new units. It's not surprising a tenant's going to be willing to pay more for that than they would than what's on the left. At a $14,000 cost, $210, $250 in premiums is an excellent return on investment for that type of work. Again, here's where the classic unit looks like, in good shape but need a renovation, and here's where we can take it to. Renters in the market and on site have shown the willingness to pay higher rents for these kind of finishes. Faux granite countertops, it really pops when you see it in person. And now here is where it all comes down to. Year one, kind of some of that organic rent growth, and as we start to initiate our business plan, NOI will be about $1.85 million. As rents in the market, in this strong market, inherently naturally grow a bit over time, but more importantly, we take all those classic units and bring them to the higher rents and the higher renovation levels that the market demands. By year five, we're going to have about $2.6 million NOI. They may only seem like $800,000 and change or $760,000 of NOI, but when you apply the market cap rate, and we're applying 6% here, right? We're buying lower than that, and cap rates, as Vic showed, as rates will come down over the next 5 years, that's being very conservative. That's adding $11 million in value to the property. That's how the value-added business plan works. We increase the NOI, the corresponding price someone pays for the property will go up for that higher cash flow.
This topic comes up a lot. This is going to be the last Viking Capital deal in 2023. Everyone witnessed last year how the IRS phased out bonus depreciation, started its step-down process. We've gone from 100% of bonus depreciation down to 80%. It's very confusing. A lot of people feel an 80% versus what you're actually going to get on your K1, which is how we report on these LP investments. So 80%, the way I think about this, you're getting to capture 80% of the actual depreciation that the property creates. So if it creates $9 million in depreciation, you're getting $7 million, and then that $7 million gets divided by all of the LP equity. Viking Capital, as a general partner, doesn't take any of the bonus depreciation or any of these passive losses. They're all shared by the LP. For this deal, our preliminary cost seg analysis has come in. We're expecting about 45%. So on that same $100,000 example, you're expecting a $45,000 passive loss in box 2 on your K1, which you'll be able to use in your subsequent tax year. So next March, $45,000 passive loss to offset any passive income you have. If you don't have any passive income built up, what a lot of people are doing is they're storing these losses. They're able to capture more of it this year than you can next year. And if you don't use it, you can carry it forward indefinitely until you do have passive losses offset.
And a lot of physicians, a lot of other folks who have passive gains from other things, they can use this in their businesses or anything, or surgical centers or whatever else they have. This can completely offset that. Also, all the distributions you're getting from us can be offset by this as well, because that's passive gains. So there's so many ways to use this passive loss. And as they're starting to phase this out, you really want to take advantage of it. You want to harvest it as much as you can, and you want to store it as much as you can as well. So absolutely, Chris.
And we're not CPAs, but call us, talk to us. We'll guide you the best we can, and we'll get you connected with the right CPAs that do this exclusively for passive investors and make sure all your questions get answered. We're hoping to have all the capital in by the end of this month. We'll have an early December close. We can go through the fees in depth as well. Pretty standard. You have an acquisition fee, asset management fee, and a disposition fee. We can go through those on a scheduled call, and I can walk you through the underwriting as well. Another question is, can we carry forward the bonus depreciation from previous years after it is phased out? And the answer is yes. So once you earn the bonus depreciation in the year that the property is acquired, you're able to move that forward indefinitely and use it when you have passive income. So if you think you're selling your practice to private equity next year, you can get bonus depreciation today that you would be able to offset in a subsequent year's tax.
People are asking about when they get their distribution. So we believe in monthly distributions. Within a certain time period of closing the property, we start distributions, 60, 90 days. The IR team will tell you the actual details and specifics. But essentially, once we have firm control of the asset and it's starting to produce cash flow, then we start doing our monthly distributions. At the end of the year, you'll get a K1 for your taxes. And also year one is where you get the majority of your tax savings, your cost segregation, your tax benefits. Someone asked about what a 70-30 split means, Judah.
As Chris had mentioned earlier, there's the pref payment everyone gets, the either 7 or 8% for B in reserve and 9 for A. That's the money that the investors see before Viking Capital sees any part of their share. When it comes down to when we sell the property though, and there's a profit to be had, that profit is then split once all the investors get their preferred 7, 8, or 9% payment. B in reserve then split the remaining amount. B splits it on a pro rata basis with how much invested, 70-30, and the reserve investors will split it split 80-20. That's the profit share. That's kind of what Viking earns for, all the work that we're doing here.
We believe in our deals. That's where we want to invest as well. We want to grow our money alongside your money. So in terms of what is Viking's stake, why does Viking do these deals? Remember, we're prioritizing our investors first. And so the preferred return means investors get the first cut of everything. And upon the remaining amount, then we also want to participate in that profit share. So 70-30 partnerships, the investors get 70% and then Viking gets 30%. Reserve investor class, we make it even sweeter for them. They get 80% and we get 20. And again, we can break this down further with a call, but I just wanted to let you know that, again, we're aligned both financially, philosophically, and as partners in this deal. We co-invest alongside every deal. This deal is already filling up, guys. I don't know how much more room is left, but I encourage you to get in before we close it. There's not that many deals across the country right now. Many sponsors have pencils down. We're one of the few that have actually found a reasonable deal that's exciting and it's attracting a lot of investor attention. So please get in while you can and take advantage of that bonus depreciation.